Hello, I'm Michael Reinking, Senior Market Strategist at the New York Stock Exchange, and this is Market Storylines. Every week, we are here to keep you up to date on the key trends and events driving global markets. We are recording on Thursday afternoon in what's been a volatile and busy week of earnings and ahead of Super Bowl Sunday. So let's get to it. Now, last week, Eric took you through a pretty non-eventful Fed meeting and the start of tech earnings, which had been met with a mixed response. Now, there was a bit of a counter-trend move within equity markets, with the S&P 500 outperforming small and mid-cap indices for the first week in 2026. Now, while it was a pretty quiet week in equities, Eric highlighted the continued decline in the US dollar and surge within the metals complex. But he also had a sneak peek, a preview of what was to come, as gold fell around 10% intraday on Thursday in a 30-minute window before bouncing back. Now, there are a couple of ways to describe this week's trading: a momentum and speculative unwind, the big rotation, but my two favorites are SAAS Pocalypse and commodity. No, you can't find the definitions to these words in Webster's dictionary, and one of them was actually made up on the Mac desk, but we'll help with the definitions throughout this week's episode. But before that, let's talk about the big headline from late last week and what turned out to be a bit of a spark to some of the volatility: President Trump's nomination of Kevin Warsh to replace Fed Chair Powell. So who is Kevin Warsh? He is a former Fed governor serving from 2006 to 2011 during the Great Financial Crisis. He was one of the finalists to replace Janet Yellen in Trump 1.0 and a close confidant of famed investor Stanley Druckenmiller, whom Treasury Secretary Bessent also has ties. Now, his name has been near the top of candidates since this process kicked off and had moved into pole position as the president said he wanted the other Kevin, Hassett, to remain in his current role. Now, there was a brief moment in time that BlackRock's Rick Rieder moved into the top of the odds board on Polymarket, but this announcement was not really all that surprising to markets. Now, in terms of monetary policy, Mr. Warsh had historically been known as an inflation hawk, though his argument to lower rates in the current environment centers around the increase in productivity, partially related to AI adoption, which he believes could be disinflationary, coupled with structural improvement in the economy related to deregulation and tax reforms. Now, this very much aligns with the administration's stated policy goals and view of the Treasury Secretary. Now, the aspect of this policy stance where markets and risk assets have gotten a bit more concerned centers around his views related to the Fed's balance sheet and QE. Now, he was critical of the continued expansion of the central bank's balance sheet in the aftermath of the financial crisis in his time on the committee, a view he's maintained as he believes this is distorting markets, encourage risk-taking, and increase the role of the central bank over the economy. Now, he believes the central bank should focus on the use of traditional monetary policy tools and that the burden should shift back to the fiscal side of the equation. Now, the shrinking of the balance sheet in practice will take time, but one of the concerns is whether he would be reluctant to use this toolkit in the face of another crisis, potentially lowering the strike price for the Fed's proverbial put. Now, in addition, he called for an overhaul of the organization, highlighting mission creep and the need for the Federal Reserve to update how it processes incoming information. Now, from here, the approval process will take some time, as there are key members of the Republican Party who have publicly stated they will not approve any nominations until the ongoing DOJ investigation is complete. And if approved, he will then need to figure out how to ingratiate himself to the same group of people that he has been highly critical of. Now, last Friday, the response within equity markets was muted. There were some signs of defensive posturing with consumer staples and healthcare moving higher in a down tape. Now, the Treasury market response was also pretty tame, with a modest steepening of the yield curve. However, this did trigger a bounce back in the US dollar, which had just tested the 2025 lows in the prior session, and a sharp unwind within the metals complex, with gold falling over 10% intraday on Friday and silver declining over 30%, hence the term commodity. The rally in commodities, particularly precious metals, has been ongoing for a couple of years now, but had gone parabolic since the start of the year, driven by a mix of increased central bank purchases and the narrative around the debasement or de-dollarization related to growing fiscal deficits and Washington's foreign policy. Now, silver had become king of the growing momentum, benefiting from the themes I just mentioned, along with its industrial use case in electrification, data center buildouts, and growing speculation. Now, early last week, we highlighted SLV was the first ETF outside of SPY to be the most actively traded issue since we've been tracking the data over the last 12 or so years. Now, there were also surging volumes in Asia and in gold and silver perpetual futures contracts in on decentralized crypto exchanges. Now, that backdrop provided the tinder, and the Warsh nomination provided the spark. Now, the volatility continued over the weekend with the crypto complex selling off. Bitcoin broke below 80,000 and the November lows ahead of the meeting between bank and crypto trade groups at the White House on Monday. Now, that didn't yield much in the way of movement, but marching orders were given to come to a compromise by the end of the month to get the Clarity Act back on track. Now, the selling has only accelerated through the week, with Bitcoin down over 20% for the week, its worst since 2022, currently trading just under 65,000. Now, this has bled into the unwind of many other, more speculative and thematic retail favorites within the equity market. Now, the commodity has also continued. The metals complex did try to bounce off key technical levels, but has also turned lower again. Now, moving to the other term of the week, the SAAS Pocalypse. Now, we've been highlighting underperformance of software stocks within the market for some time now, with the idea that AI could shrink the workforce and decrease the amount of licenses, but more importantly, vibe coding, whereby companies can build their own in-house software solutions with the use of AI instead of paying for these subscription services. Now, over the weekend, there was news of an update of Anthropic's Claude Cowork AI offering to include plugins for areas like legal and finance, which sent shockwaves through financial markets, causing sharp selling in software, data analytics, and staffing firms. This also raised some concern within private credit markets about exposure to the sector and has hit many asset managers and private equity companies. Now, the iShare Tech Software ETF is down over 10% for the week and about 25% year to date. Now, coming out of the weekend, Congress did pass a short stopgap funding bill, but not before this week's BLS employment report had to be postponed. JOLTS jobs openings were delayed but released this morning, dropping to around 6.5 million from 7 million last month. And this morning's initial claims also moved up to about 230,000 this week, which, along with some of the defensive bid, has pushed Treasury yields lower today, reversing the move higher earlier in the week after ISM manufacturing turned positive for the first time since last January. Now, I've been highlighting quite a bit of negativity throughout today's episode, but when you take a step back, the picture isn't so bad. The S&P 500 is down a little less than 2% for the week and trying to hold 6,800, which coincides with the lows of December and January. Now, the equal weight version of the index is actually slightly higher, and while I'm recording, the S&P mid and small cap indices are up about 1%, though the Russell 2000 is down a similar amount given the exposure to the momentum and thematic favorites mentioned earlier. Now, the NYSE FANG Plus Index is down over 5%, where much of the pain is, with Amazon earnings on deck this evening. Now, last night, Alphabet had very strong numbers, but announced that it would double CapEx levels in 2026 to around $180 billion. Now, this was about $60 billion above consensus. To put that in perspective, that difference is more than the total CapEx spending by ExxonMobil over the last 2 years. Now, looking ahead, we've got the Super Bowl and the Olympics to look forward to. And if you want to take a break from football on Sunday, you can tune in to see how the elections in Japan are going. Now, this could get some attention as it's been a driver of global yields recently. Now, the key economic data next week will include retail sales, the delayed jobs report on Wednesday, and CPI on Friday. Earnings will also remain busy, but the major names are out of the way until we get to the late cycle tech and retail earnings later this month. Now, that's going to do it for this week. Thanks for spending some time with us. If you liked today's episode, please tell a friend or leave a comment wherever you listen to your podcasts. I'm Michael Reinking, and we'll talk to you again next week.